Build your dreams, live rich, and leave rich.
Welcome, everyone. If you've ever felt completely lost trying to pick stocks on Delau Street, almost like you're trying to find your way through a giant maze, you are definitely not alone. Today, we're going to demystify that entire process. We're going to look through two essential lenses that every single investor really needs to understand. It's the million-dollar question, isn't it? What stock should I buy, and when it's the right time to buy it? If you get it right, you're on your way to building wealth. But if you get it wrong, you're just left scratching your head, wondering what happened. But what if I told you there are two proven frameworks that can guide these huge decisions? Think of them as your secret weapons for the stock market. So in this explainer, we're going to break down these two powerful philosophies. First, we'll uncover what they're all about at their core. Then, we'll look at the unique tools that each one uses. And finally, and this is the important part, we'll see how you can actually combine them to create a really powerful investment strategy. Okay, so what are these two lenses? It really all starts with two fundamentally different ways of looking at the exact same company. Imagine two experts, both analyzing, say, Infosys. They're looking at the same stock, but they're asking completely different questions and looking for completely different things. See, on one side, you've got the detective. This is the fundamental analyst. They dig deep into a company's financial health, trying to uncover what it's truly worth. And on the other side, you have the psychologist, the technical analyst. They're not reading financial reports, they're reading the market's mood swings and momentum to predict where the price is going next. One is all about the what, and the other is all about the when. So first, let's put on our detective hat. A fundamental analyst is kind of like a financial Sherlock Holmes. They're poring over balance sheets, income statements, and cash flow reports, hunting for clues about the real health of a company. They are looking for evidence that reveals a company's true value, not just the price it's trading at today. So what is this intrinsic value they're searching for? Well, think of it like buying a house. You wouldn't just blindly pay the asking price, right? Of course not. You'd look at the condition of the house, the neighborhood, what similar houses have sold for. Intrinsic value is that same exact idea, just applied to stocks. It's all about figuring out what a company is really worth, so you can hopefully buy it for less. Now, one of the most common ways to find these hidden gems is using something called the top-down approach. This strategy is so powerful and so respected, it's actually part of the official curriculum for investment advisors in India. It's a really systematic way to sift through thousands of stocks to find the few that have the most potential. Here's how it works. First, you zoom way out and you look at the big picture. How is the Indian economy doing? Is it booming or is it slowing down? Once you get a sense of that, you zoom in a bit to a specific industry that you think is set up for big growth. Maybe it's AI or renewable energy. And only then, after all that work, do you finally pick your champion, the specific company you believe is the strongest in that field, like a Reliance or a TCS. Okay, let's switch gears completely now and step into the shoes of a market psychologist. These are the people you see staring at charts all day, the chartists. They believe that the key to making money isn't in a company's balance sheet, but in the collective psychology of the market. They're trying to read the hopes, the fears, and the greed of millions of investors, all reflected in the patterns of a simple stock chart. You see, the core belief of a technical analyst, and this is a big one, is that everything you could possibly need to know is already baked into the stock's price. As the official NISM textbook says, all information is reflected already in its stock prices. So in their view, you don't need to be a detective because all the clues are right there on the chart for everyone to see. This whole philosophy is built on a few really simple key ideas. Think of the stock market like a big river. It doesn't just flow in a perfectly straight line, does it? No, it twists and turns, it has fast parts and slow parts, but it always follows a general direction or a trend. Technical analysts believe that these trends are driven by human psychology, and by identifying these patterns, you can predict where the river is probably headed next. So we've got two very, very different philosophies here. One is based on digging into a company's fundamentals, the other is based on market psychology, so it makes sense that their toolkits would be just as different, right? Let's take a look at the actual instruments each of them uses to make their buy and sell decisions. For our fundamental detective, one of the most important tools in the kit is the PE ratio. The easiest way to think about it is like a price tag, but for a company's earnings. A high PE ratio is like an expensive designer handbag. It's pricey because people expect it to be a high-quality product with great performance. A low PE ratio, on the other hand, is like finding something in a bargain bin. It's cheap, but it just might be a hidden gem. The PE ratio helps you try to figure out which is which. And this is where you can really see the difference. A technical analyst or market psychologist, they look at a chart just like this one and they see a story unfolding. They see this constant tug of war between buyers and sellers, the moments of excitement and moments of fear. They're looking for patterns in this big battle that can give them an edge, a little clue about who's likely to win the next round. Now, to see that bigger picture, technical analysts use tools like moving averages. Think of it like this. Imagine you're looking at a long, winding road from a helicopter. From the ground, it's hard to see where you're really going, but from way up high, you can see the overall direction of the road. A moving average does that for a stock price. It gives you that bird's eye view by smoothing out all the daily bumps and turns to reveal the true underlying trend. Another really powerful tool they use is called Bollinger Bands. Imagine a rubber band that's stretched around the stock's price. When the market is calm and quiet, that band is tight. But when things get volatile and crazy, the band stretches way out. These bands act like a visual guide, telling you when a stock might have moved too far, too fast, and could be due for a snapback. So you've got the meticulous detective on one side and the intuitive psychologist on the other. It's sort of a classic case of logic versus emotion. But here's the real question. Do you have to choose a side? Well, for many of the world's most successful investors, the answer is a resounding no. And this is where everything really comes together. This idea right here of using fundamental analysis to figure out what to buy and then using technical analysis to decide when to buy, this is an absolute game changer for so many investors. It's about combining the very best of both worlds to create a strategy that is both really solid and well-timed. Think of it as a simple two-step process. First, your inner detective does all the heavy lifting, all the research, to identify a high-quality company that's selling for a fair price. Then, once you found it, your inner psychologist takes over, scanning the charts for that perfect entry point, that moment when market sentiment seems to be turning in your favor. It's a powerful 1-2 punch that can really improve your results. So here's just a quick side-by-side to sum it all up. Our detective is playing the long game, looking for great companies to hold for years. The psychologist is more of a short-term strategist, looking for opportunities to profit from the market swings. The key for you is to understand which role you're more comfortable playing and how you can use the skills of both to your advantage. Ultimately, there's no single right answer here. There's no one-size-fits-all approach. The best strategy is the one that lines up with your personality, your goals, and how much risk you're comfortable with. The whole journey to becoming a successful investor really starts with self-awareness. So take some time and think about it. Are you more of a detective, a psychologist, or a little bit of both? The answer could be the key to unlocking your financial future.